ARB Group is an electrical product distributor based in Durban, and it managed to weather tough economic conditions in the year to June. Byron Nichles, who's the chief executive, is with us in studio. Byron, we spoke about, well, going on for 2 years ago. Your share price then was R3.30. You said at the time that you needed to get more free float in the market. You were hoping that you'd see the shares improving. Well, they certainly have. Today's announcements, and we'll get into those in a moment, has seen you up to R4.90. So a good return. Have you got to your potential?
Well, certainly. Thank you, Alec. We believe that certainly the market has rewarded the performance of ARB over the last couple of years. In terms of the free float specifically, while it has improved as what is still classified as a small cap, we still think that there's scope to improve the free float considerably. What you find, though, is with the results being what they have, there tend to be a couple more buyers than what there are sellers of our shares right now. So the free float is certainly something that we're still looking to improve.
But you certainly seem to be focusing on trying to get the share price going higher. You had a special dividend today. It seems to be the fashion of the moment. We saw ABSA issuing a special dividend. There was another special dividend from Italtal yesterday, and yourselves paying a considerable part of your capital back. What's the motivation in your case?
Sure, the motivation is we've always had a very strongly cash-generative business, and over the years, through the strong cash generation, with no debt on the balance sheet, we've noticed the balance sheet perhaps being a little bit lazy and the capital structure being perhaps suboptimal. And when the board sat yesterday and engaged, we looked at the cash flow generation of the business, we looked at the cash requirements of the business going forward, as well as our own acquisition aspirations. And all of that taken into account, we felt that there was still surplus cash in the business, and hence the decision to return it to shareholders.
That's a manager talking. Your controlling shareholder, the guy who founded the business 30 years ago, has run it in a particular way for a long time, keeping big cash balances so you can do the kind of acquisitions that you've done in the last little while. What's this about lazy balance sheets when you're in an uncertain economy?
Well, certainly, when you look at the business, and over many, many years, it's been very, very cash generative. Continues to be cash generative. The balance sheet structure and the asset underpin that we've got a very strong and large property portfolio which don't get. While we're certainly not anxious to introduce debt into the business, we are cognizant of the fact that with interest rates at all-time lows, the business could certainly sustain a level of debt. And sitting with cash in the bank, shareholders certainly don't look to us to leave their cash in the bank. They're looking for returns. Taking all of that into account, we still felt that there was surplus cash in the business to return.
So does Alan Burke still have 50% of the equity?
Alan holds just over 50%, yes.
And he voted in favour of the special dividend as well, presumably?
He voted. He's the chairman of the board, so he voted in favour of that.
It is interesting to see family businesses getting run by professional managers, that there's a different priority or a different focus that comes into it. Italtal also yesterday, special dividend being distributed, a family business that had a very heavily covered dividend in years gone by. And I guess we should, if that's the way you guys are doing it, and they've done it as well, we should be looking for other stocks on the JSE with a similar approach.
Yeah, I think, and certainly not my forte, but dividends certainly make up a big part of investment returns, particularly in uncertain markets. Whether something peculiar or unique to sort of family-run or family-controlled businesses, not quite sure, but certainly with strong cash generation, that can never be a bad thing.
Family-controlled businesses that get run by professional managers, quite clearly. The financial results that you put on the table, though, are very impressive again. 28% profit before interest and tax. Your margins are up a little bit as well, and you've made a couple of acquisitions.
Yeah, certainly we were pleased with the results. There's no secret that the going out there is tough. It seems to get a bit tougher. And through the acquisitive strategy that we put in place a couple of years ago, we started seeing now those benefits come through, both at the top line and the bottom line. And it's a strategy that we'll continue to pursue.
Have you sufficiently consolidated in your industry, or are there more opportunities?
There certainly are more opportunities. If you look at the electrical wholesaling sector as a whole, it's a very fragmented sector, a very fragmented industry. So we certainly do see consolidation opportunities from time to time. Although, as we've shown over the years, we tend to be quite selective around which acquisitions we pursue and which ones make strategic sense for us. As and when those opportunities arise, if we think they can be value accretive, we certainly will continue to look to consolidate them.
So you declared a 16-cent dividend, which is up 18% on last year's dividend, another 10 cents special dividend. Where is your capital position now?
The cash.
Well, you said that you had excess capital, so you wanted to give away or give it back to shareholders. Correct. I'm trying to gauge whether we can have another special dividend next year.
Yeah, that certainly would be something for the board. Where we sit right now is at year-end we reported 203 million of cash after the payment of the dividends, which get paid on the 9th of September. That would take about 65 million rand of that cash out of the business. So still a very healthy cash position. We certainly believe that the business will continue to generate cash, and I think the dividends reflect the board's optimism and confidence in the business. At the same time, we're looking to deploy that cash through acquisitions, through growth initiatives, to generate a better return than what it currently earns in the bank.
You know, Byron, what's worrying me here, we had a discussion with Wayne Sampson from Ellie's just the other day. They've got a huge opportunity that's coming with the new television broadcaster, and they decided to not pay a dividend because they wanted to keep the money on the one side to take advantage of that. You're in the infrastructure field. You've got a government in this country, in South Africa, who's desperate to spend money on infrastructure. We haven't seen it come through yet. Sure. But once those taps are on, one would presume that there would be as big an opportunity in your sense as there is for Ellie's, yet you're paying special dividends. I don't get the long-term thinking here.
Yeah, I think if you look, and certainly I can't really comment on Ellie's, but I think if you look at the structural, or the structure of the two balance sheets, yeah, they're very different. ARB's cash generative has absolutely no debt in the business. I think Ellie's has got quite a lot of debt in the balance sheet. So, yeah, I don't think that the comparison is necessarily
so you're comfortable?
We're certainly comfortable that we can gear up and that the business will continue to generate sufficient cash to fund all the growth initiatives that we see in the foreseeable future.
Byron Nichles is the Chief Executive of ARB Group, a business that is based in KwaZulu-Natal. The shares have really performed well over the past couple of years. I suppose the question has to be, can it continue? That was Byron Nichles, CEO of ARB. Standard Bank reported an 11% rise in first-half earnings as strong loan growth helped offset a spike in bad debt charges. Sim Shabalala, Chief Executive of Standard Bank, joins us now. Well, Sim, those bad debt charges that we mentioned